the gold certificate account, which is the collateral for the Federal Reserve notes, was basically there in a 1-to-1. So if we take a look at what it would take to do that right now, it's somewhere between $8,000 and $9,000 per ounce.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Paul from belangp YouTube channel. We spoke just over 2 years ago in 2020. And yeah, we haven't spoken since, but I got an email from Paul the other day talking about the Federal Reserve's balance sheet. And if there's a guy who knows how to comb through the balance sheet, it's Paul. So I thought it'd be interesting to have him on. I highly recommend you go to his YouTube channel as well. He does some great work there, belangp. Paul, welcome. How are you?
Hi, Mary. I'm doing great. Glad to be back and happy to be talking to you.
Yeah, I'm happy to be talking to you again as well. And maybe we can jump right into some interesting discrepancies, excuse me, that you found in the Federal Reserve's balance sheet, and it's to do with its real estate holdings, which might not sound very important, but we're still trying to figure out if it is, but it seems quite interesting.
Okay, well, let me share my screen. Okay, can you see it?
Yeah, great.
Okay, so this is one of the exhibits that I had on a recent video where I pointed this out. I was taking a look at the Fed H4.1 release, which I do periodically. They release this about every week, and it discusses the assets, the liabilities, and whatnot, the general financial condition of the Federal Reserve. So it's a good place to go because the Fed does a lot of jawboning. They move the markets by talking a lot. And the H4.1 report actually shows us what they're doing as opposed to what they're saying they're going to do. So I typically will take a look at this to find out if they actually are tightening credit or if they're just talking about tightening credit. But you can take a look here. This is table 5 in the report. And this shows the assets that they have on their balance sheet. And we can see that they have about $8.9 trillion worth of assets. And this is what most people refer to when they talk about the Federal Reserve balance sheet. They talk about the assets. So we're very close to about $9 trillion. I'd be surprised if we weren't close to $10 trillion by the end of this year, if not next year. And we can see several different categories of assets that they have on their account. One of which I talk about a lot is the gold certificate account. So these are basically historical artifacts that go all the way back to the Gold Reserve Act of 1934. And this is when Franklin Roosevelt called in all the gold from the banks and put it into storage in the Treasury. And in return, because we have an amendment against, not compensating people for taking, their property, they gave the Federal Reserve these gold certificates, which essentially is a claim on the gold. It's not an exercisable claim, so that the Federal Reserve can't go to the Treasury and demand it. But the Treasury has stated that if for any reason the Congress were to dissolve the Federal Reserve, they would take over all of the assets and all of the liabilities, which include these gold certificates, which are the claims on the roughly 8,000 tons of gold held in Fort Knox. And then when we talk about the rest of Federal Reserve assets, we're talking mainly about credit instruments. So these are, bills, bonds, and notes of the federal government, which are guaranteed to at least pay back on a nominal basis. And then we have other things on here, such as federal agency debt, which has an implicit guarantee from the federal government, and some mortgage-backed securities. They also have certain loans like government guaranteed student loan interest. But we can see that those securities add up to about $8.8 trillion out of the roughly $8.9 trillion. And the rest of it is gold. And there's some other property on here. But this is what I thought was very interesting. the bank premises, which is the value of the land and the buildings that the Federal Reserve owns, sits right now at $621 million. We might not think that that's a very big number compared to $8.8 trillion, but it is fairly substantial relative to their total capital. And we'll talk about that in a minute, the difference between their capital and their assets. But we can see here in the table that although it's currently at 621 million, it's changed over the past year by $1.3 billion. So this number, as of April of last year, was hovering at about $1.9 billion. In fact, a year before that, it was about $2.2 trillion. But even if we use the 1.9, I'm sorry, I said trillion, I meant billion. Even if we use the $1.9 billion as a starting point, this $1.3 billion here represents a 68% drop from where they were a year ago. And that seemed astonishing to me, why the Federal Reserve would need to do that, because for all of these assets that you see in this table, these are not marked to market. Okay, these are all settlement values, the values that you would have after maturity. So they're essentially at par. Gold is carried on the books at $42.22 per ounce. The bonds, bills, and notes are basically registered at par. And the bank premises, I believe, are based upon the time at which they were acquired, minus some depreciation that they've had over time. So for the Federal Reserve to write down the value of its land and buildings is quite significant, I think. I just can't quite figure out exactly what it means at the moment.
Yeah, and maybe you could show us the chart so people can see how much it's changed.
Sure. Sorry for the emoji here. That's what
That's all right. It is a shock. It's like, the cliffs of Dover here in the UK.
Oh yeah. But I mean, you can see this over the past 10 years. This comes from the St. Louis Fed database. Back in 2003, the bank premises at the Fed started at about $1.6 billion, and they steadily climbed over the subsequent 5 years to get to about $2.2 billion, where it sat for quite a long period of time. I mean, there was a small jump in 2012, but it settled out at about $2.2 billion. And then this is what happened over the past year. Now, if I saw a company do this, a public company, I would say, no, I do not want to own that stock. There's something going on in the company that's a little worrisome. And I have not seen any explanations yet as to what this is. Some of my viewers have speculated that maybe what's happening is the Federal Reserve has decided to sell all the property and lease it back. That would certainly, create an easing in terms of their management burden, but I don't see why they would need to do this. I mean, it's one of the most powerful institutions in the world, and they have seemingly endless access to what we would call money. So for them to do something like this that would send a potentially troubling signal, I don't know why they would do this voluntarily.
Yeah, I mean, they have access to infinite funds or reserves, and they don't have to pay anyone for it. So why would they want to lease it out? It doesn't make sense. Yeah, the numbers compared to the assets on the balance sheet are quite small, but maybe we could go, or you could go over a little bit how leveraged the Federal Reserve is and how big really is their equity or capital, because I've been speaking a little bit about that in the last few weeks, that a lot of central banks around the world, including the Bank of England, they're concerned now because a lot of the value of the assets that they have on the balance sheet, like government bonds or treasuries and mortgage-backed securities, have been going down a lot this year. I saw the TLT, which is an average of 20-year, is down, 20-year treasuries is down about 21% this year alone in terms of price. And I know that they marked this to market, but yeah, maybe you could go over the fact that it could have something to do with the fact that the Federal Reserve's equity is under threat. And I think the Federal Reserve is the most leveraged bank or hedge fund in the world, I would say.
Yeah. Let's talk about that. In reality, they're actually not as leveraged as they might appear on paper, right? But this paper game is more or less an illusion. Everything that we call the dollar is, it's a credit illusion. So let's go through the balance sheet quickly here. So there's two tables in Table 5. There's assets and there's liabilities. Tell me if this is scrolling correctly on your screen. You're able to see it? Okay. So when we talk about assets, most of what we're referring to are the basically debt that's been purchased from the US government. So we talked about this earlier. It's the bonds, bills, and notes, federal agency debt, mortgage-backed securities, and so forth. And then there's some physical property that they have. We talked about the bank premises, and we have gold on the balance sheet. And so the assets that they have are worth about $8.9 trillion. Now let's go over to the liabilities. So how did they get all these assets? Well, basically what happened is when the Federal Reserve was first formed, it had a bunch of banks pay into it, and they paid in what's called paid-in capital. So we can see that down here in this table. This is the capital paid in. So over time, this has grown to be about $34 billion, right? So it's actually very small relative to the amount of assets that they have on their balance sheet. But the reason why they have so many assets is that they trade liabilities for them. So the main liabilities of the Federal Reserve are the Federal Reserve notes. So these are physical paper notes that circulate throughout our economy and the world economy. There's about $2.2 trillion worth of them right now. And the Treasury has admitted that these physical notes, which are printed by the Bureau of Engraving and Printing, not actually created by the Federal Reserve themselves, stand as first liens against all of the assets of the Federal Reserve. And then we have other things such as bank deposits. So bank deposits are essentially liabilities of the Federal Reserve System. So there are $4.5 trillion worth of bank deposit type liabilities on the liability side of the Federal Reserve balance sheet. And part of that is an account that the Treasury holds at the New York Fed, which is called the US Treasury General Account, which used to be very close to zero, but recently over the past 10 years has expanded quite a bit and currently sits at close to $1 trillion. So this is money that the Federal Reserve, the Treasury has on deposit with the Fed, and the Treasury can mobilize it at any time that they want for any purpose that they want and spend it without getting congressional approval. So this is just like a big piggy bank for the Treasury. And then we have some other cash items here. So the total liabilities are about $8.9 trillion. Now, when you take, according to generally accepted accounting principles, when you take the assets of an organization and subtract off the liabilities, what you're left with is the equity. So this is basically what the shareholders of the Federal Reserve actually own. So we would be taking $8.939 trillion, subtracting off the $8.898 trillion, and arriving at what we call the capital. So this is the equity of the shareholders, which is currently at $41 billion. Now, if we take this just at face value, the $8.9 trillion worth of assets is roughly 216 times the total capital. So this means that the Federal Reserve is leveraged about a little over 200 times, which is a razor thin margin. And what this means is that if any of those assets were to default, for example, it could put the Federal Reserve in a situation of complete insolvency, where their ability to honor their debts would be called into question. And so when we take a look at the change here in bank premises, which over the past year was $1.3 billion, although that's a very, very small change relative to $8.9 trillion, it's a meaningful change with regard to their capital. It's about 5% of their total capital. So this would say that the reduction here essentially would have wiped out about 5% of the capital. But what I believe probably happened was that it showed up somewhere else on the asset register. So they essentially swapped the value of their premises for some other asset, because we're not seeing that total capital has decreased over the past year. It's actually increased by about $2 billion.
Paul, maybe you could also go over how the gold certificates could also be valued a lot higher, which would change the leverage of the.
Oh yeah, sure. Okay, so let's go back up to the assets and talk about the gold certificate account. Now, as I mentioned, the value that's being held on the balance sheet for the gold certificates is at $42.22 per ounce. And it's been that way since the early 1970s. The Federal Reserve has not marked the gold to market. And this stands in contrast to what the European Central Bank does, because the European Central Bank marks their gold to market, I believe, once every quarter. And they put that out in their reports. Now, this is an ace up the sleeve of the people in charge. So if the Federal Reserve were to get into trouble and their equity went below zero, essentially indicating a bankruptcy type situation, the gold certificates could be marked to market, meaning that instead of valuing them at $42.22 on the books, giving them a total value here of $11 billion, they could market to the currently, I believe it's $1,870 some dollars per ounce. And that would change this $11 billion to $400 billion and change. So it would be quite a substantial change. It would be about an increase of 40 times. And when you take that change and you compare it to their capital, it would essentially increase their capital by about tenfold. Right. So the Fed's actually in much better shape than how it looks on the books. But one thing that I've been wondering, though, is at what point in time is the Federal Reserve going to have to acknowledge the value of the gold that they have claimed on their balance sheet? I think if they were to get into trouble, they would have to revalue. But the problem with revaluing is you can really only do it once, because as soon as they do something like that, everyone's going to know that something is seriously wrong and that gold actually does have significant value in the financial system, which means that if you only have one bullet in your gun, you want to make it count, which means that if they get into serious trouble, what is more likely to happen in my mind is that they would put an offer out for gold. So they would do something similar to what the Russian central bank has done recently, which is a lot of people think that the Russian central bank has pegged the ruble to gold, and that's only half true. If you take a look at the press release from the Russian central bank, what they did was they offered to purchase gold at a specified price. They never offered to redeem rubles in exchange for gold. So it's like a unidirectional flow of gold as far as the central bank is concerned. And this was to basically keep the gold flowing in Russia and to prevent the gold industry from shutting down. So if you think about the mechanics of what that would do, if the Treasury, for example, were to offer to purchase in unlimited amounts gold at some very high price, let's call it $8,000 per ounce, just to pick an arbitrary number, then what would happen is gold would flow into the Treasury and in exchange notes would go out. But the most important thing would be there would be a recapitalization event where instead of this being 400 and some billion dollars, the gold certificate account would swell to, let's say $5 or $6 trillion, and that would completely fix any accounting problem that we had on the balance sheet. It's what I would call a recapitalization event. So that's what I mean when I say that gold at some point will recapitalize the world.
And does the Federal Reserve, for example, treasuries have gone down a lot in price this year. Does it revalue those holdings, or does it just keep it at par? Or is the market looking at that and saying, well, we know that eventually when those notes, bills, and bonds mature, they'll get 100%. But and maybe the Fed doesn't, they market to par, and that's, I'm wondering whether they would need to recapitalize if they're getting, par, eventually get par, because the Treasury can always pay par. They'll just print the dollars and pay it back. But maybe the market is seeing the inflation, the currency losing value. Is that what you think is happening?
Well, the Federal Reserve keeps everything on the balance sheet at par. And I believe that's partially one of the reasons why they only carry assets that have some kind of a government guarantee. Because as long as they have that government guarantee, it's legitimate to hold them on the balance sheet at par, at least according to an accounting standpoint. I think the reason why they do not mark to market is, as leveraged as they are, 200 and some to 1, if they did mark to market the assets, then periodically it would show them with a negative equity. And it would basically show them as a bankrupt institution. But just holding everything at par and just assuming that the government's going to come in and make everything whole means that they can run these outrageous leverage ratios. And it's quite profitable for them. But I don't think personally that it's a real honest way of accounting for the liabilities and that the Federal Reserve holds. I did have another thought about the supposed student loan forgiveness that's going to be announced soon. Biden has hinted at this. He didn't want to go for the $50,000 per person student loan forgiveness, but he said that he was certainly considering $10,000 or more. And personally, I'm kind of aggravated by that, being a person that has honored my debts in the past. But I think one of the reasons why it might be happening may be related to this balance sheet issue. Because if the Federal Reserve actually is holding some of these student loans, and I believe that they are, if they were to default, if the students that took them out, for example, weren't able to get jobs in their field and they had to default on them, that default by itself would cause one of these line items here to change. And with the narrow, thin margin that the Federal Reserve is running, it wouldn't take too many billions of dollars worth of student loan defaults to put them into bankruptcy. And force them to do something drastic, such as revalue the gold certificate account.
Yeah, it's interesting that you said they only keep things that are guaranteed by the government, but interesting that they keep gold, which doesn't have to really be guaranteed because it's real money. And maybe we could talk a little bit about what you think this might mean, that the fact that the premises change is so big. Do you think it could mean that they have some accounting problem?
Well, that's the only thing that I can think might have happened. As I mentioned earlier, being the sort of institution that they are, and the fact that they don't have to mark things to market, makes me wonder why they would need to shuffle things from this one category, being bank premises, and move it somewhere else. It does signal that there is a balance sheet problem, which they keep on. I think they can keep on kicking the can down the road for a certain amount of time, but eventually they're going to reach a point where they're going to have to take much more drastic action. And I think what they're trying to avoid right now is this situation where they revalue their gold assets. I always view, the power structure as those who are in power basically treat debt as their wealth. So, everyone else's debt is basically their wealth. And as long as they can use that as a way to skim real wealth off of the real economy, and it works, I think they'll try to keep the current system in place. But as soon as that system starts to sputter, which I think we're starting to see signs of that now, we're starting to see some significant problems in the supply chain. People are waiting for a very long time to receive orders for, building, equipment and things like that. As soon as the debt becomes too crushing for the little person to pay, and the skimming operation no longer really functions, then the people that are in power right now are going to have to figure out a way to reduce the burden on the common person and reestablish that flow of goods and services. So what I think they're going to do at some point is like a bit of a debt jubilee, but it won't be obvious to everyone what's happening. It'll look a lot like debt's being forgiven, but at the same time, the people who are in power, they're going to want to stay in power. They're going to want to keep their wealth. So this revaluation of gold, I believe, is one of the ways that they're going to do that. So if they hold a certain amount of other people's debt as their wealth and also gold, and the debt shrinks, if their gold holdings increase proportionally, that means that the people who are currently the wealthy and in charge will continue to be the wealthy and in charge. But it will essentially recapitalize the world, reduce the debt burden on the people who are paying the debts right now, and allow the system to continue.
Yeah, it's like an escape valve, I guess, isn't it? And that you don't use very often. And I think the last time they used was in 1980, when gold was traded up to almost 900, and I think the Dow to gold ratio went almost 1-to-1. Just to finish off, what do you see with inflation? I mean, I personally think we're going to continue to see higher prices because it's already been baked in the cake. The Federal Reserve was wrong about it being transitory, and I think they're wrong about it, about being able to control it and bring it back down.
I think you're right. The Fed has a lot of models, and the models tend to be static. But what those models don't do is deal with people's psychology. And if you take a look at hyperinflationary events elsewhere, I'm not saying that we have a hyperinflation right now, at least not yet. It essentially is a function of the fact that all of the ingredients are there for a major inflation, but then there's a psychology shift that causes people to all of a sudden lose faith in the currency. And so I think where we are right now is they put all the gunpowder in the gun, and they essentially loaded it. And then we ended up with a situation where because of the government action to the pandemic and all the lockdowns, we had a supply chain issue, which then caused availability of goods and services to go down. And then we had this war in Ukraine, which is causing some uncertainty in the area of energy supply, and to a certain extent, some foods, because Ukraine makes a lot of foods that they export to the rest of the world. We're getting to a point now where people are starting to see prices going up. And if you listen to some of the news reports, they're quite concerned about this. And so it doesn't take too long of that kind of an event to really start to cascade and end up with a situation like what we had in the 1970s. And it could get even worse. It could become similar to what happened to Germany during their hyperinflation, or to Venezuela. We're not there yet. But one of the interesting things that happened in the 1970s, by the way, that target or that price of gold that we ended up with in the early 1980s, that was not an arbitrary number. If we take a look at the currency in circulation, which is the Fed's main liability, and compare it to the gold certificate accounts, that $850 mark was precisely what it took to make the mark-to-market value of the gold certificate account exactly equal to the currency in circulation at the time. So remember what I mentioned earlier, which was that the Treasury considers the currency in circulation as the first lien against the gold certificate account of the Federal Reserve. Well, once we got to that point at $850, the gold certificate account, which is the collateral for the Federal Reserve notes, was basically there in a 1-to-1. So if we take a look at what it would take to do that right now, it's somewhere between $8,000 and $9,000 per ounce.
Very interesting. Paul, before we wrap up, could you tell the viewers where they can find your work and maybe talk about a book that you wrote in the last couple of years or so that's just come out, I think?
Oh yeah, sure. Well, you can find my videos at BELANGP. So that's my YouTube channel. And if you prefer written articles, I started a website called evidencebasedwealth.com. So a lot of the work that I do in videos, I go into more depth in written articles. So if you like written articles, please check out that site. I just self-published another book. It's called Evidence-Based Wealth. It's out on Amazon.com. It's about 300 pages, and it is more about financial planning and saving for retirement and the different vehicles that are available for people, how to avoid drawdowns in retirement and things like that. So it's more of a basic book. It doesn't go into a lot of this stuff with the Federal Reserve balance sheet.
Great. Paul, thank you very much for your time. And whenever you want as well, I can come on your channel if you'd like. And maybe we shouldn't wait another 2 years to talk again.
Yeah, sure. That'd be great.
Yeah. Have a great rest of the weekend and take care.
Okay, you too. Bye.
Bye.